Are you looking to become a more consistent options trader? I want to share with you in today's video why I use vertical spreads in the majority of my options trades and how they can help you to put you on the path of being a profitable trader as well. Now, I can admit that in the 17 years of being a market strategist, I certainly have struggled for many years to understand what it takes to be a profitable trader. Because when you first start out, you think that it has to do with the tools, the indicators, and the strategies that you've learned. But as I've worked with thousands of retail and institutional customers, I've learned that strategy is almost never the reason why some traders are successful and others not. I've learned that it simply has to do more with your ability to remain disciplined and, more accurately, how you are able to regulate your emotions and your decision-making process, especially during times of stress, when you're facing losses. That's when we make our least rational decisions that typically lead us to make huge losses that are almost impossible to overcome. Now, while working on managing your emotions is an ongoing process even for the best traders, there are tools that you can use that assist you on this journey. And vertical spreads, they happen to be, in my opinion, one of the best strategies with assisting me in sticking to my trading plans. Vertical spreads have become my go-to choice due to their limited risk nature and adaptability to almost all market conditions. So I'm going to show you why I prefer vertical spreads in over 80% of my options trades and how they can help you overcome and maintain discipline and achieve more consistent results in your trading. If building a disciplined approach to trading vertical spreads interests you, I've recently taught a masterclass on vertical spreads that you can check out in the link in the description below. The foundation of discipline. Vertical spreads inherently have limited risk, which make them an ideal choice for building that discipline. Both credit and debit spreads have defined max loss, which allows you to understand your max risk up front and manage your trades accordingly. This particular characteristic encourages a more strategic mindset, focusing on preventing account blowups over making profits. Credit spreads for trend following, higher confidence, consistent income. Let's start with the vertical spread that I use most often. I use credit spreads most often simply because there are far more opportunities to trade them than other strategies. Credit spreads are by nature a high probability of success strategy that can be deployed whenever you have what I call a loose directional view. And that means if you can take a look at a chart and see an overall bullish or bearish trend, that's a candidate for selling credit spreads. And you'll likely find yourself in that position quite often. So when I have a higher confidence in a directional view and I'm following a trend, I typically opt for selling credit spreads and look for an edge using three important elements: liquidity, volatility skew, where I'm collecting as large of a percentage of the vertical width as possible, relatively close to 40%, and waiting for the right timing. And only when all three criteria align will I pull the trigger on a trade. Even if one of those three rules are not satisfied, I will not trade it. This helps me remain disciplined in my trade entries. Debit spreads for counter trend trading, favorable risk to reward, large directional moves. When I find a more rare counter trend trading opportunity, that's when I typically prefer to use a debit spread structure. Counter trend trades by nature happen far less often, and they require an asset to reach such an extreme level that it warrants a trade in the opposite direction. And I prefer to look at stocks that are so beaten up that everyone in the markets thinks they're worthless, or shorting stocks that everyone is telling me to buy. These are the types of setups, when timed correctly, lead to very sharp moves over a very short period of time, which leverages the convexity of a debit spread structure. It allows you to trade these quick moves with less risk and far more potential reward relative to the risk that's taken. And because they have such strong risk to reward, even if you can get 30 to 40% of these ideas right, you can still be profitable in the long run. And the three things that I look for when trading a counter trend move with a debit spread is, again, liquidity, relatively inexpensive options where the IB rank is below 20%, and extreme moves in the underlying stock or ETF measured by either momentum or standard deviation. Now, counter trend trading is a very different ballgame and requires far more discipline, in my opinion, and debit spreads allow me to ensure that the risks that I take remain small each time. Vertical spreads for earnings, maximizing potential, minimizing risk. Trading earnings can be really challenging, but I have found that vertical spreads offer the best potential to make more while risking less. By carefully selecting strike prices and expiration dates, you can construct the vertical spreads that takes advantage of the anticipated price move movement of an earnings announcement. Some people see these binary events similar to gambling, but my earnings approach takes into account a few important elements that provide me with the confidence to trade every earnings cycle. First, valuations. Bullish setups on undervalued stocks and bearish setups on overvalued stocks. Relative strength. Bullish setups on strength, bearish on weakness. And remember, trading earnings can be a volatile period of the calendar year, but when used in conjunction with vertical spreads, it can lead to a pretty exciting few weeks in the quarter. Vertical spreads are my preferred option strategy due to their limited risk nature and how adaptable they are to just about any market condition. But most importantly, it's an incredibly important tool in my toolbox for keeping me disciplined to my own trading rules. It allows me to utilize the limited risk nature of an options contract to force risk controls on myself. Especially if you found yourself struggling with sticking to your risk management rules when you're faced with a loss, or you tend to hold on to losses for far too long, consider utilizing an option strategy that controls that on your behalf. By using credit spreads for trend-following trades and debit spreads for counter-trend trading, you can remain disciplined while capitalizing on different market outlooks. Embracing vertical spreads as a disciplined trader can help lead to most consistent and profitable results in your options trading journey. And if you have found this video useful, check out the full masterclass that I recently taught on vertical spreads that you can access using the link in the description below. In this masterclass, I take a deep dive into the construction of each strategy, how to find the same setups as me, and every one of my exit rules. It even wraps up with a session on how to build a profitable mindset. So check out the Vertical Spreads Masterclass with the link in the description below, and please consider supporting us by simply hitting the like button and subscribe to our channel so you can see my next video in this series. And please leave a comment below and let me know what has been your experience trading credit and debit spreads and whether or not it's helped you onto your path for profitability. With that, thank you so much and have a great trading day.